Good afternoon. I'm Lucas Lachance, a partner in the Practice Growth Group at Lane Gorman Truitt. LGT is a mid-sized accounting firm located in Uptown Dallas. We've served our clients for more than 70 years in tax, audit, and accounting and consulting services. If you have any questions about what is discussed today or would like to set up a free consultation, please contact us at askus@lgt-cpa.com. Thank you for joining us for today's Accounting Update for Not-for-Profits webinar. This is the first of several not-for-profit webinars for 2021, and I hope that you'll be able to join us for future events. Before we start the presentation, a quick disclaimer can be seen on the screen next to me. Our first presenter is David Ovison, a partner in our Assurance Services Department. He's been with the firm since 1987 and has more than 35 years of experience in public accounting, predominantly in the not-for-profit space. He's responsible for the accounting and tax services for a number of organizations and businesses, and he also leads our retirement benefit plan practice. David also provides advisory services related to designing, implementing, and critiquing internal control and financial reporting systems, and preparing forecasts and projections. His presentation will give you an understanding of what accounting changes need to be made for your organization to properly record PPP loans. Please welcome David Ovison.
Hello, everyone. Today, I will be providing an overview of the options that can be used to account for the Paycheck Protection Program loans and providing financial statement recording and disclosure examples. In response to the COVID-19 pandemic, the Corona Aid, Relief, and Economic Security Act was signed into law on March 27, 2020, which included the PPP loan program. Availability and second-time borrowing under the PPP were extended and expanded under later legislation. An organization can borrow money guaranteed by the SBA through their bank. The principal and interest may be eligible for tax-free forgiveness if the proceeds are used on required levels of payroll, rent, utilities, and mortgage interest, and certain eligibility and forgiveness criteria are met. Currently, PPP loans are not subject to the single audit requirements. There are four options to account for PPP loans under the CARES Act. The first is ASC 470, debt, IAS 20, accounting for government grants and disclosure of government assistance, ASC 450-30, gain contingencies, and ASC 958-605, revenue recognition. We're going to dive into these options and what is available for not-for-profit organizations. When selecting any of these options that are available to your organization, it does not result in the adoption of a new accounting policy unless the organization has a pre-existing accounting policy. Just to get things started, there is no guidance existing in US GAAP that specifically contemplates the accounting for forgivable loans obtained from or guaranteed by a government entity. The American Institute of Certified Public Accountants, also known as the AICPA, work with the Financial Accounting Standards Board, as well as various expert panels, and issued Technical Questions and Answered number 3200.18. Although these Q&As are not sources of established authoritative accounting principles as described in the FASB codification. It really boils down to whether management elects to treat the PPP loan as debt or under the other three models if certain conditions are met. Something else to consider is that the PPP loan is not considered legally forgiven unless and until the SBA has fully paid the lender and that funding and the related forgiveness has been communicated from the SBA and bank, preferably as evidenced by a canceled loan document. The loan is not considered forgiven if an organization has applied for forgiveness while the bank is reviewing the application or after it has been sent to the SBA for approval. We recommend the organization should disclose the method of accounting for the PPP loan in its financial statements. Disclosures may also include 1, the amount received, 2, the amount of forgiveness included in income and or deferred, 3, the basis for recognizing any deferred amounts, 4, the terms and conditions of receipt, and 5, unfulfilled conditions and any contingent liability for repayment. Regardless of whether an organization expects to repay all or a portion of the PPP proceeds or believes it represents in substance a grant that is expected to be forgiven, The organization may elect to account for the loan as a financial liability in accordance with ASC 470. Under the debt option, the PPP loan is treated as debt on the statement of financial position and a financing activity on the statement of cash flows in the same manner as in the other financing arrangement. The organization should accrue interest and account for principal under the terms of the loan, but would not impute additional interest at a market rate, even though the stated rate may be below market, because transactions where interest rates are prescribed by governmental entities are excluded from the scope of ASC 835-30 guidance on imputing interest. The PPP loan is carried as a liability with current and long-term portions if a classified statement of financial position is presented until either one, the loan is partially or wholly forgiven, and the organization has been legally released, which is when the organization's application for forgiveness is approved, or two, the organization has paid off the loan. Upon receiving legal forgiveness, the organization should record a gain on the extinguishment of long-term debt if all or a portion of the PP loan are not forgiven, with repayments being applied as appropriate against accrued interest and the loan balance. Here we have an example of a not-for-profit organization that received $500,000 in PPP funding on May 1st, 2020. The terms of the funding agreement indicate that the NFP must utilize the proceeds to fund or offset qualifying expenses over a 24-week period. The terms of the agreement specify that the NFP must repay the principal of the loan back, plus interest, which accrues at 1% semi-annually and matures in 2 years. The total interest calculation is $10,000, which is the $500,000 principal times the 1%, which equals $5,000, times 2 years equals $10,000, or $2,500 every 6 months. Upon maturity, the loan and accrued interest payable may be forgiven and the NFP fulfills the agreed to terms. The following is an example of how to record the transaction. So on initial funding, you debit cash for $500,000, you credit the note payable for $500,000. Then as we calculated the interest, you debit interest expense and credit accrued interest payable for $2,500 for each 6-month period. So you multiply the $2,500 by 4, and that gets your total interest of $10,000. Then when the debt is forgiven, you debit the note payable for $500,000, you debit accrued interest payable for $10,000, and then you recognize a gain on the extinguishment of debt of $510,000. Now, for any portion of the debt that is not forgiven, any portion of that $500,000, you would credit cash, which is when you pay the note, and reduce that gain on extinguishment debt by the corresponding amount. And here's a footnote disclosure for a PPP loan that has not been forgiven at year end, with the actual verbiage depending on whether or not the organization has applied for forgiveness. The key disclosures include the amounts, interest rates, maturity date, payment schedule, guarantees, and other significant terms of the loan agreement. Not really any different than what is normally disclosed for debt arrangements. Here is a continuation of the previous disclosure on the previous page. And I just want to point out the contingency footnote discloses the readers of the financial statements that the PPP loan forgiveness is subject to SBA review, depending on the size of the PPP loan. It also discloses the status of the loan and how the loan forgiveness is presented or will be presented in the financial statements. If a business entity, which is not a not-for-profit organization, expects to meet the PPP eligibility criteria and concludes that the loan represents in substance a grant that is expected to be forgiven, it may account for the PPP loan as a government grant by analogy to IAS 20. Under this model, government assistance is not recognized until there is reasonable assurance, similar to the probable threshold in US GAAP, that 1, any conditions attached to the assistance will be met, and 2, the assistance will be received. Once there is reasonable assurance that the conditions will be met, The earning impact of the government grants is recorded on a systematic basis over the periods in which the entity recognizes as expenses the related costs for which the grants are intended to compensate, for example, payroll costs. In other words, income is recognized over the period ultimate forgiveness is earned, which is the period in which the entity recognizes the related costs. Under this model, there are two choices for presenting the grant revenue on the income statement. It can be presented as one, a credit as a separate line item or under a general heading such as other income, or two, it can be shown as a reduction of the related expenses. Specifically, a business entity would record the cash inflows from the PPP loan as a deferred income liability and reflect the liability until the grant proceeds are earned. Classification of any liability remaining at the financial statement date should match the expected forgiveness timing, which presumably would be current for 2020 financial statements. However, if the grant becomes repayable in the future, meaning forgiveness is not obtained, the change in the expectation should be treated as a change in accounting estimate and accounted for prospectively. Repayment of the grant previously recognized is to be first applied against any unamortized deferred grant liability, with any excess immediately recognized as an expense. And just to note, this model is not available for nonprofit organizations, and therefore we have chosen not to present further information on this particular option. ASC 450-30 gain contingencies. Under this model, the earnings impact of the gain contingency is recognized when all the contingencies related to receipt of the assistance have been met and the gain is realized or realizable. Simply put, under ASC 450-30, a for-profit entity would initially record the cash inflow from the PPP loan as a liability. The proceeds from the loan would remain a liability once all contingencies related to receipt of the loan, along with the manner in which the loan proceeds have been used, have been met, and forgiveness is considered realized or are realizable with remote likelihood of reversal, at which point the earnings impact would then be recognized in the financial statements. And again, this model is not available for non-for-profit organizations, as well as its method is not preferred by most CPA firms, organizations, and stakeholders. So we have chosen not to present further information on this option either. This is the last option, ASC 958-605, revenue recognition, conditional contributions. US GAAP gives guidance to not-for-profits when recording contributions under ASC 958-605. Although the scope of ASC 985-605 exclude business entities, the FASB staff has acknowledged that business entities are not precluded from applying this accounting model by analogy when appropriate. Under this ASC, if a contribution is conditional, it is not recognized until the conditions are either explicitly waived or substantially met. In cases where conditions are met over time or in stages, contribution revenue should be recognized as qualifying expenses are incurred. Under this model, the proceeds from a PPP loan would initially be recognized as a refundable advance on the balance sheet, a liability, until the conditions for forgiveness are waived or substantially met. The not-for-profit organization would subsequently recognize contribution revenue as it incurs qualifying PPP expenses, assuming all other conditions are substantially waived or met. And here we have another example of an NFP organization that receives $500,000 in PPP funding. The terms of the funding agreement indicate that the NFP must utilize the proceeds to fund or offset qualifying expenses, again, over a 24-week period. The terms of the agreement specify that the not-for-profit must repay the principal of the loan back plus interest, which accrues at 1% semi-annually and matures in 2 years. And again, the same interest calculation applies in this example as well as the previous one. It's $10,000. So upon maturity, the loan and the accrued interest payable may be forgiven if the NFP fulfills the agreed to terms. So the following is an example of how to record the transaction and assumes that the expenses are incurred at a rate of $50,000 per week. Now, I have seen some guidance that the organizations do not need to accrue the interest expense because they take the position that this is a grant and not a loan. And my suggestion would be is to consult with your CPA firm to see what their recommendation is, or at least discuss the issue with them. So for any portion of the debt that is not forgiven, you would credit cash for the debt repaid and reduce the contribution revenue by that same amount. So it's very similar to the other example. When the initial funding is received, you debit cash, you credit the refundable advance payable. And then the only thing that's really different from this other example is you can see that as the expenditures occur at $50,000 per month, you debit the expense, you credit cash, and then you also release the contribution revenue. You reduce the advance payable by that same amount. And this is a footnote disclosure for the PPP loan that is being accounted for under ASC 958-0605, with the actual verbiage depending on whether or not the organization has applied for forgiveness. Very similar to the previous disclosure example. This is the continuation of the disclosure on the previous page. The contingency footnote disclosure informs the readers of the financial statements that the PPP loan forgiveness is subject to SBA review, depending on the size of the PPP loan. It also discloses the status of the loan and how the loan forgiveness is presented or will be presented in the financial statements. This footnote discloses how the organization is accounting for the PPP loan as a conditional contribution. Disclosures also include 1, the amount received, 2, the amount of forgiveness included in income or deferred, 3, the basis for recognizing any deferred amounts, 4, the terms and conditions of receipt, and 5, unfulfilled conditions and any contingent liabilities for repayment. And this is an additional continuation of the footnote disclosure with the actual verbiage depending on when the organization has received forgiveness and how much was forgiven. Of the 2 options that are used by NFP organizations, accounting for your PPP loan as a conditional grant will allow you to recognize revenues quicker than using the debt model. Of course, we always recommend discussing these options for accounting for PPP loans with your CPA firm. If you need any help, we have a dedicated PPP team at LGT that can answer any questions you might have or provide you with more information when accounting for your PPP loans.
Thank you, David. We appreciate that presentation. I know David touched on it briefly, but just as a reminder, LGT has established our PPP Loan Task Force. So be sure to reach out to us if you have any questions about how to handle your PPP loans. Our next presenter is Babita Sherchen, a principal in our Assurance Services Department. Babita has more than 10 years experience auditing not-for-profit organizations, government entities, and schools. She has extensive experience not only conducting audits, but also overseeing them. She works to develop our staff by assisting in recruiting, developing training aids, and acting as an instructor or discussion leader for professional development programs within the firm. Thank you, Babita.
And good afternoon, everyone. Today I will be covering the Shutdown Venue Operators Grant, also known as SVOG grant. So just to give you a quick overview of the grant, the Shutdown Venue Operators Grant program was established by the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. It was signed into the law on December 27, 2020. So this date is important, so keep in mind December 27, 2020, as this will come up quite a few times later on in the slides. The program includes $15 million in grants to applicants who meet the eligibility requirements and is administered by the SBA's Office of Disaster Assistance. So this is one of the coronavirus relief options for not-for-profits. It's not just for not-for-profits, but today's presentation is going to be focused around rules and regulations for the not-for-profit organizations. So this is a one-time grant, so it does not need to be repaid. Unlike your PPP funds or the EIDL funds that need to be either forgiven or repaid, this does not need to be repaid as it is a grant award. However, if you do receive SBOZ award, you will need to document the appropriate use of funds, and you could be subject to single audit if you meet that threshold. The eligible applicants may qualify for grants equal to 45% of gross earned revenue, and the maximum single grant award is capped at $10 million per award. Of the $15 million, at least $2 million of the total program is reserved for eligible small operators with up to 50 full-time employees. The way SVOG grant award calculates employees is that any employee that works at least 30 hours per week are considered a full-time employees. Employees that work between 10 to 29 hours are considered one half of a full-time employees. And if you have employees that work less than 10 hours, they are not considered employees for the SVOG grant purposes. So who is eligible and who can apply for the grant? There are 6 different type of entities that SBA has come out. And they are your live venue operators and promoters, theatrical producers, live performing arts organization operators, museum operators, and I'll talk more about the museum operators in the next slide, as there are various different organizations that fall under this category. And your last 2 categories are your motion picture theater operators and talent representatives. So how is a relevant museum defined? For the purposes of SVOG grant, a museum is a public, travel, or private not-for-profit agency or institution organized on a permanent basis for essentially educational, cultural heritage, or aesthetic purposes that uses a professional staff, owns or uses tangible objects, cares for tangible objects, and exhibits the tangible objects to public on a regular basis. So this includes your aquariums, arboretums, botanical gardens, your museums of all genres, so art museum, children's museum, general museum, history museum, you name it all. It also includes your planetariums, science and technology centers, as well as your zoological parks. So what are some of the eligible entity requirements? Number 1 is that entity was operational and earning revenue as of February 29, 2020. Also, 25% or more gross revenue loss between one quarter of 2019 and the corresponding quarter of 2020. And lastly, upon the application being awarded, the SVOG grant, the entity needs to show that it has resumed or intends to resume its principal business activity. While entities were originally prohibited from receiving both forms of SBA assistance, the American Rescue Act, which became law on March 11, 2021, just last week, has removed this restriction. So you can now apply for both the PPP funds and SBOG funds. And we'll talk more about that in later slides. But as I mentioned, that the last requirement of this grant is that you would need to either be in operation or plan to resume operation. So for those entities or the eligible entities that are undergoing reorganization, form of bankruptcy, whether it be Chapter 11 or Chapter 13, you may apply for SBOG. But if you are undergoing a liquidation form of bankruptcy, which is your Chapter 7, then you're not eligible to receive the SBOG award. Now that we've looked at some of the qualifying factors, let's take a look at the eligible entity disqualifications. So if your entity does not operate primarily in the US or is not located in the US, you are not eligible for the SVOG award. So basically, if your organization does not contribute to the US economy through payment of taxes or use of American products and materials or labor, then you're not qualified. Also, entity cannot be publicly traded corporation or majorly owned or controlled by a publicly traded corporation. Entity cannot present live performance or sell products or services of a prurient sexual nature. An entity cannot own or operate venues, theaters, museums, or talent agencies in more than one country or in more than 10 states, and cannot have more than 500 employees as of February 29, 2020. And lastly, entity cannot have more than 10% of its 2019 gross revenue come from federal government. However, that does not include your disaster assistance. So when you're calculating your 10% of 2019 gross revenue, you can exclude any form of disaster assistance that you may have received. So now let's take a look at the SVOG grant distribution timeline and their priority listing. For the first priority, SBA will be focusing for their distribution to entities that suffered a 90% or greater revenue loss between April 2020 through December 2020 due to the pandemic. So that's going to go from day 1 through day 14 once the application window opens. As I mentioned earlier, the application window is not open yet. Then the second priority will be given to those entities that suffered a 70% or greater revenue loss between April 2020 through December 2020. And that's going to be for the next 14 days. Then the third priority will be given to those entities that suffered a 25% or greater earned revenue loss between one quarter of 2019 and the corresponding quarter of 2020. So it could be any quarter, but it has to be the corresponding quarter. And that will begin on the 28th day after the first and the second priority awards are made. Also, there could be supplemental funding, assuming there's still funds left after the first, second, and third priority awards are made. And that will be awarded to the recipients of first, second, and third priority round awards who suffered a 70% or greater revenue loss for the most recent quarter as of April 1st, 2021 or later. So depending on when they open the window, that will be the most recent quarter that they're going to look at in determining who receives the supplemental funding. One thing to note though, although this priority is set, this does not define when you can apply for the grant. Even though you may fall onto either the second priority or the third priority, you can still apply for your grant award on day 1 once the application window opens. So I just wanted to make that clear that you do not have to wait until the 14th day or the 28th day to apply for your grant. This timeline is more for SBA to determine when they're going to process and the order of when they're going to process the awards. All right, so in this slide, we're going to take a look at calculating the SVOG grant amount. There are 2 different methods based on when you are in operation. If your organization was in operation on January 1, 2019, you would take the 45% of 2019 gross earned revenue. And if your organization was in operation after January 1, 2019, there are 2 different steps. So first, you would take the average of monthly gross earned revenue for each full month in operation during 2019. Then you would multiply that average monthly revenue by 6. No matter which category you fall under, the maximum allowed is $10 million per award. So once you calculate, if your award amount is below $10 million, that's the amount that you're going to be awarded. But if it's above $10 million, then it would be the $10 million that you're going to be awarded. So here is an example of calculating your award amount, assuming that you are not in operation on January 1, 2019. So in this example, the business started on February 15, 2019. So as you can see, on February, they made $25,000 in gross earned revenue. March was another $25,000, April was $50,000, May was $100,000, and so forth. But keep in mind that this business started on February 15th, and when you do your calculation, the partial months are not included. So in this example, we would only take revenues from March through December. So the sum total of the earned revenue from March through December is $925,000. Then you would take that and divide that by 10 for the 10 months, March through December, to get your average monthly earned revenue, which is $92,500 in this example. Then you would multiply that by 6, and that's what your award amount is. In this case, it's $555,000. We talked about earned revenue and gross earned revenue in previous slides. So what is earned revenue and gross earned revenue? As required by the Economic Aid Act, the SBA is defining earned revenue and your gross earned revenue, the two terms in the law, in accordance with the common principles of the accrual method of accounting. So using this, only monies the organization receive from the sale of goods or services are counted as earned revenue. This commonly accepted definition of earned revenue does not include other sources of funds that an organization may receive, such as donations, sponsorships, governmental assistance, or returns and investments. Your gross earned revenue is the total of earned revenue from various sales of goods or services, such as admissions tickets, merchandise, food and beverages, advertising sales, contracted presentation income. So basically, what constitutes your earned income is basically your program income. So any income that you generated from whether providing services or goods is counted towards your earned income or earned revenue, but anything that you received excuse me, is not counted towards your gross earned revenue. All right, so we'll take a look at the fundraising event receipts and membership fees next. For the purposes of SVOG grant award, fundraising event receipts and membership fees will be treated as they would be for your tax deduction purposes. So the portion of the amount or the membership cost an individual pays in connection with an event or membership, which represents the estimated value of goods or services they receive in exchange or provided as condition of membership, must be included in gross earned revenue. Similarly, the portion of the amount or the membership cost an individual pays that exceeds the estimated value of goods or services they receive or provided as a condition of membership will be considered a donation and is not included in your gross earned revenue. For not-for-profit organizations, grants are excluded from gross earned revenue, but SBA will consider the organization's federal grant revenue to determine whether it meets the eligibility limit of having no more than 10% of its gross revenue from federal sources. Again, that does not include the disaster assistance. If you have rental income, whether it be from longer-term tenants or short-term rentals for event hosting, that should be included in your earned revenue. So now let's take a look at some of the other COVID-specific economic aid programs that not-for-profits were eligible for. The main popular ones were the COVID Economic Injury Disaster Loan, also known as your EIDL, and your Paycheck Protection Program, also known as PPP. So you are not prohibited from applying for SVOG award if you already have a COVID EIDL loan or plan to apply for one, and also if you received PPP funds or apply for one. While originally entities were prohibited from receiving both forms of SBA assistance, the American Rescue Plan Act, which became law on March 11, 2021, removed this restriction. However, under the law, the entities will be ineligible for a PPP loan after you receive SVOG award. Also, recipient of other pandemic-related relief and other assistance from state or local government does not disqualify you as long as you're an eligible entity to receive the SVOG award. And as a federal grant program, all funds awarded under SVOG will count towards your requirement to comply with the Single Audit Act if it receives $750,000 or more in federal grant funding during the single fiscal year. So does PPP loan affect SVOG award? Per the American Rescue Plan Act, an entity that receives PPP loan on or after December 27, whether it's your first draw or second draw, will have the PPP loan amount deducted from SVOG amount. So for example, if an entity received PPP loan for $10,000 on February 1, 2021, and then applied for and received an SVOG award, which based on the amount of earned revenue loss would have been $100,000. The entity's SVOG will be reduced by the $10,000 that you received in PPP loan. So the entity would receive $90,000 in SVOG award. However, any PPP borrower that received a PPP loan before December 27, 2020 will not have the PPP loan amount deducted from any subsequent SVOG award. So the key date here is December 27, 2020. So if you had received PPP loan prior to this date, December 27, 2020, it does not affect your SVOG award. But if you did apply for and receive the PPP loan after December 27, 2020, then your SVOG award will be deducted by that amount that you received in PPP funding. As far as forgiveness, it has no bearings on your SVOG award. Whether it was fully forgiven or partially forgiven, it does not affect your SVOG grant award. It's how much you applied for and received. That's the amount that's going to be deducted from your SVOG award. Here we'll take a look at some of the expenses that are eligible to be used towards your SVOG funds. A lot of these expense categories are similar to that of the PPP funds. So you have your payroll cost, rent payments, utility payments, scheduled mortgage payments, scheduled debt payments for existing loans, workers' protection expenditures, and other ordinary and necessary business expenses, including maintenance costs. The other expenses that are also allowable under SVOG grant award are your payments to independent contractors, and that's limited at $100,000 per contractor. Your administrative cost, state and local taxes and fees, operating leases that were in effect as of February 15, 2020, and your insurance payments. They also allow you to pay for your advertising, production, transportation, and capital expenses related to producing a live performing arts production. However, these cannot be your primary use of funds. So while SVOG program has extensive eligibility requirements, once you receive the award, funds can be used for a broad use of funds. You can also use to refund customers that are still holding tickets for your canceled events. But the key point to note here is that you are not allowed to double dip. So if any payroll cost was applied towards your PPP funds, you cannot also apply that towards your SVOG award. So how to apply for SVOG award? As of now, SBA is not accepting SVOG application. And according to the most recently released frequently asked question, SBA is anticipating to open the SVOG applications in early April. So what can you do in the meantime? There's a couple of things that you can do to get a head start. First would be to make sure to register for your DUNS number. And keep in mind that other identifiers, such as your individual taxpayer identification number or the employer identification numbers, cannot be used. Once you have your DUNS number, you want to go ahead and register in the System of Award Management. That's your sam.gov. Registration is free, but it could take up to 2 weeks. So you want to make sure you go ahead and do your registration sooner than later. Also, SBA has released a preliminary checklist for your applications. So we would recommend that you refer to that checklist and start gathering your supporting documents. The SVOG application process is still under development, and the list in the preliminary checklist is not comprehensive. There could be additional items that they request once the application is released. So please make sure to review the preliminary application checklist and gather your documentations. SBA will reject any SVOG application where an entity submits an incomplete application, or is attempting to commit fraud against federal government, or fails to meet the definition of eligible entity. Or if you lack the required level of revenue loss, or possess one or more of the disqualifying conditions that we talked about earlier. As of now, like I said, the application is not open. But once it opens, you don't need to wait for the priority listing. You can go ahead and apply on day one. So if you qualify for both PPP and SVOG award, you want to make an informed decision about whether or not you apply for both, because there is pros and cons of both. The PPP funds are subject to forgiveness. Whereas an SVOG grant is not. Once you receive, you don't have to pay that back. However, there is extensive list of eligibility requirements that you have to meet. And also, if you spend more than $750,000 in SVOG grant, you could be subject to a yellow book audit or a single audit. So you want to keep all of these things in mind as you are deciding to apply for these grants. I will say that if you are planning to apply for both, make sure you're applying for your PPP loan before you apply for your SVOG grant. Because once you receive your SVOG grant, you will not be eligible to apply for the PPP funds. And this should not be an issue right now because the SVOG application does not anticipate on opening until beginning of April, and your PPP deadlines are end of March, so it should not be an issue. But if for some reason the PPP loan application deadline is extended and there is a window where you are eligible or you are allowed to apply for both, make sure you apply for the PPP funds before you apply for SVOG if you are intending to apply for both and receive both awards. So that's all I had for today's presentation. But if you all have any questions or need any assistance with determining whether you're eligible for one or the other, or what are your grant amounts that you are eligible for, definitely give us a call or email us, and we will be happy to assist you with that. Thank you.
For more information about any of the topics discussed today, please be sure to visit us on social media, or you can email us at askus@lgt-cpa.com.